All right, good morning. So I'm very excited to be here today and follow that wonderful presentation. Today I'll be discussing some key findings from my recently published book, How Novelty and Narratives Drive the Stock Market, Black Swans, Animal Spirits, and Scapegoats. If you take away anything from my presentation today, it is that if sophisticated enough, a textual news analytics platform can help detect the timing, magnitude, and nuance of structural change that is instability in the stock market. So it is convention in economics and finance to ignore unforeseeable change, narrative dynamics, and the Knightian uncertainty that envelops it all. At best, researchers typically just assume it away. So, for example, let's start with the seminal study of Shiller 81, who plots P against P star, where P is the aggregate stock market price. Here he uses the S&P 500, but also the Dow Jones 30 in his paper, against P star, which is the present discounted value of future dividends. And these are realized ex post dividends. And if you assume the rational expectations hypothesis, then P, the stock market price, should approximate the optimal forecast of P star. So Shiller uses detrended data here, and you can see that P does not approximate P star. In fact, P undergoes persistent deviations away from P star for years, if not decades, at a time. These deviations are very large. And I just update his data and leave in the trend, just to show you on the right-hand side here that the persistent deviations remain. So this has, of course, led to this great dichotomy in the literature that asset prices in general are either driven by a time-varying risk premium or by behavioral biases, psychological considerations that are usually disconnected from fundamentals and technical momentum trading. So much so that Akerlof and Shiller, in their book Animal Spirits 2009, state that no one has ever made rational sense of the wild gyrations in financial prices, such as stock prices. So there is a new subfield of economics introduced by Shiller as a way to explain aggregate outcomes, namely narrative economics. And in a series of works, Shiller likens the spread of stories about asset markets, the economy, and policy to that of infectious disease through the SIR model to explain contagion and public attention to events. Importantly, Shiller recognizes the time-varying and mutating nature of narrative dynamics, which naturally are connected to the culture, society, and zeitgeist of the era in question. Specifically, he uses Google Ngrams as a story's proxy, tracking terms such as secular stagnation, the Laffer curve, Bitcoin, housing bubble, financial crisis, and so on. He states in his AEA presidential address in 2017 that the field of economics should be expanded to include serious quantitative study of changing popular narratives. However, and I do think that this is crucial, Shiller frames narratology under ex post irrationality and illogic, and states that narratives and the associated dynamics impede complete and logical response to news. And he sort of frames them under the umbrella that narrative dynamics are contributors to feedback effects, a la his Irrational Exuberance 2000 framework. So my book, published with Cambridge University Press, is a response to Shiller's call. And so I elevate the importance of narrative dynamics for understanding the stock market and its associated outcomes, trying to document how investor story threads change through time. However, my book fundamentally departs from Shiller by conducting the first comprehensive empirical analysis. So half of the book is descriptive and qualitative, and half of the book is empirical in various ways. And I try to look at sort of the nature of narratives and also sub-narratives at both the aggregate and firm level of stock prices, returns, volatility, fund flows, trading volume, and so on. So I connect narratives to inherent instability arising from streams of novel events. And these novel events I categorize as macro novel events and micro novel events. The micro novel events are connected to corporate outcomes. I frame narratology under Knightian uncertainty, a la Knight 21, and the inherent ambiguity about new market relations given instability. So what is Knightian uncertainty? Knightian uncertainty is that change which cannot be modeled probabilistically ex ante. So if you think that a novel event has occurred, such as an armed conflict, a new monetary policy regime, these events are going to cause structural change in the relationships driving asset prices and outcomes. How do you deal with those new relationships? You rely on narrative dynamics to help contextualize the meaning of those events for the future. Financial markets are forward-looking inherently. And if you assume that the change that occurs can be modeled stochastically, you are ipso facto assuming away unforeseeable change. So if you believe in Knightian uncertainty, you believe that change does not follow an objective probability distribution that could be known ex ante. And this is the foundation of the Novelty Narrative Hypothesis that I advance in the book, NNH. So at the micro level, you could think of novel events as management shakeups, bankruptcies, product recalls, corporate legal issues, labor strikes, M&A, and et cetera. And the Ravenpack taxonomy has been instrumental in understanding just the spectrum and absolute depth of all the novel events that could occur at the corporate level. It's absolutely amazing. And all the nuance of how an event can occur. At the macro level, you could have a new Fed chair, a shift in fiscal or regulatory policy, natural disasters, political elections, armed conflicts, and so on. What do these events do? They cause unforeseeable structural change in the relationships driving stock market outcomes. So Marcos spoke a lot about the functional form, f of x. So if you believe in the novelty narrative hypothesis that I advance in the book, there's a time t subscript on that f. So f sub t of x, the functional form relating x to y, your dependent variables, changing through time. Investors face imperfect knowledge. They face imperfect knowledge about what information is relevant and how it matters for the future. And so what do? They naturally and necessarily rely on narrative dynamics to give contextual meaning to the information. I mean, how do you interpret that we are in a recession but have an unemployment rate in the US that's 3.7%? How do you interpret the supply chain disruptions that maintain when you think about the future? So I argue that textual analysis of financial news reports are the key lens into the marketplace for understanding NNH, the Novelty Narrative Hypothesis. Why is this so? Major financial news analytic firms, they track second by second the activity in equity markets. So they're very much as a real-time component with understanding these events are hitting the market is responding, there is some sense of causality, even if it's not scientific at that moment. And that information set matters because if you're an econometrician, you have to decide what information set to bring to the data to explain the outcome. And very often, textual news analytics reports include the testimony of fund managers, analysts, and other market professionals, understanding of the event's meaning for the future. So you have a window into the marketplace. The trading decisions of these individuals actually move markets, and often they're included in financial reports. And very importantly, textual news analytics does not predetermine which factors matter for stock price fluctuations or in which ways. It leaves open the information set. So that very much is a challenge that every researcher faces, is what's on the right-hand side, if you want to think about it that way. Textual news analytics leaves that open and allows the data to speak freely. And that F sub t, relating X to Y, for textual news analytics, it allows for structural change at every point in time. So the issue of structural breaks is very real in finance and macro data. It's very real, and how you deal with non-stationarity, unit roots, and structural change is an issue that researchers face. And when you first difference, you lose a lot of those lower frequency, longer run bits of information. Structural change is there's not just one regime, two regimes, or maybe three in a Markov switching sense. And structural change can be very nuanced. It could take time to unfold, or it could be more acute. And I make that argument throughout the book. Textual news analytics also allows for emotion and sentiment to influence how investors interpret news's impacts on future returns. And in sort of responding to Shiller's call, those financial news reports are going to reveal the culture, the institutional structure, the political considerations that are just inherent in the way that we think about the world around us, in the era that we live, and how that changes over time. And of course, advances in machine learning, algorithmic semantic search, NLP, expertise tagging, what do? They help to detect and identify relevant events, which is a pillar of my book. Identifying which events are deemed relevant in the stock market. And capture the relational context surrounding them. Because isn't that what a narrative is? You have protagonists, antagonists, you have events, you have missions, you have outcomes, you have a relational structure. And the financial news reports help us to say something about that relational structure. So Ravenpack allowed me, through their identification classification platform and through their taxonomy, to say something about what does narrative intensity look like from financial news reports. And importantly, it's not just algorithmic or just manual expertise tagging. You need expertise to inform what the relational context is. Humans have judgment. Humans provide comprehension. Humans have training, expertise. They have their own experience to rely on. Humans can understand complex scenarios. The algorithms help with processing. They help with processing volumes. They help with processing speed. And when these are put together, the hybrid outcome was just extremely beneficial for helping to assess some of the hypotheses I was really interested in. And you could think about understanding, a dramatic downgrade, a dramatic market outcome versus what was expected, how entities enter and exit relationships over time. The hybrid component allows us to say something relationally about that at every point in time. Specifically for my book, I focused on unscheduled events. And that's what I call a novel event. And surrounding novel events, the text surrounding novel events, I'm able to sort of measure, to the best degree possible, novelty, relevance, sentiment, and inertia surrounding corporate events and macro events. And I argue throughout that these are the inputs to narrative dynamics. So if you are not associated with a calendar release of data, like that from the BEA or the BLS, for example, you're considered an unscheduled event. And so the corporate unscheduled events and the macro unscheduled events. The majority of the empirical analysis in the book comes from the corporate novel events, but there were some really interesting findings, specifically in Chapter 8, I'll talk about at the very end here, on the macro side. And what I found just really compelling as I was writing the book and doing the research was that there were entire chapters that I did not foresee that only revealed themselves as I went down different research paths. The twists and the turns, it was a really interesting experience. Over 2/3 of all of the events that were identified over 20 years of data are deemed unscheduled. So that gives you a sense, almost 70% in classification terms and in what was identified, actually, are unscheduled events. So to think that unscheduled events are just some tail of some distribution out there, or are just, anomalous in some sense, or they occur relatively infrequently, that is absolutely not the case. They are the majority of events that I identified over 20 years of daily, intraday financial news reports. And specifically, from January to 2021, month 3, over 11 million unscheduled events were identified connected specifically to corporate prospects and share prices. Typical month contained almost 46,000. So this is sort of my baseline corporate KU index. So this is what I call the Knightian Uncertainty Index. And when I plotted this for the very first time, I was absolutely blown away. Because what do you see here? You see pretty clear illustrative evidence of mean shifts occurring at these distinct periods. And this is just the number. This is just a very simple frequency count of unscheduled KU events. And so I thought, wow, let's go back and try to chronicle what was going on at these, sort of inflectionary mean shift points. And so in the 03-11 to 04-03, you have the ramp up in the US-Iraq War. 06-07 to 06-11, new Secretary of the Treasury, Henry Hank Paulson, thwarted terrorist attack on a flight from the US to the UK. Dow eclipses 12,000 for the first time. Democrats win both houses of Congress after midterm elections. Bursting of the US housing bubble. All of this took place within these months. 2011 months 6 through 2011-8, US debt ceiling crisis and the Budget Control Act, specifically in August. Historic at that time, Federal Reserve accommodations. S&P's downgrade of US sovereign debt, also occurring in August. 17.2 to 17.09 was the beginning of the Trump presidency, which introduced new policies and numerous cabinet shakeups. The Tax Cuts and Jobs Act, which slashed corporate tax rates. And partial rollback of many Dodd-Frank elements. North Korea launches a ballistic missile, and Trump pulls the US out of the Paris Agreement. So these are mostly macro events, but we'll see that they spill over into future corporate novelty and future corporate instability. So that was an interesting exercise, going back to try to make sense of that figure. So how do I classify narrative dynamics? I look at relevance, I look at sentiment, I look at the actual novelty, I look at volume or inertia surrounding an event, and I just, as a first pass, take a simple monthly average of these values connected to unscheduled events at the corporate and macro level. So I look at high narrative intensity and moderate narrative intensity. And what's the overarching hypothesis? That periods of high narrative intensity correspond contemporaneously to periods of instability in the stock market. So it's a contemporaneous analysis throughout the book. I'm working on book 2, which is more of a forecasting-oriented analysis, but this is contemporaneous. So when narrative dynamics are high, is there instability in the stock market? I'm trying to say something about that. And how do I approach this? For high narrative intensity, let's just look at the top 10% of ENS events. Look at the top and bottom 10% of ESS, so the most optimistic and the most pessimistic. And let's just have a threshold of 50% for relevance. So either you're relevant in the article or you're not. That is the event connected to a corporate entity or a macro entity. And so I'm interested in instability. These are the periods that meet those joint criteria before. So we have 2000, months 3, 4, and 10. We have 08, 08, which of course is a global financial crisis. We have 13, 11, and 16, 08. So this is just a graph of dummy variables equal to 1 if the joint criterion was met before for highest narrative intensity. How about moderate narrative intensity? So let's relax the 10% and just make it 25%. And we'll keep the 50% of relevance because, as I said, it's sort of binary. Either you're relevant or you're not. And you can see some clustering here. So there's definitely some clustering going on in 2008, 2013, 14, and 15. And then these months turn out to be really influential in my empirical analysis, 2016, 8 and 11, and 2017, 1 and 3. So let's just look at some of the factor models. And we know they have their limitations, but these are some of the most popularly used risk factor models. So the Fama and French, 1996. We have the equity premium here. We have the small minus big and the high minus low. Small minus big represents the size effect based on market cap. Small firms tend to generate higher returns, ceteris paribus. And high minus low, this is the value effect based on book to market. So high book to market tends to generate higher returns, ceteris paribus. And then in 2015, Fama and French had 2 more factors to make it a 5-factor model. I know that there's, I think, a 12-factor model out there. And so I'm just using these as sort of benchmarks to look at for understanding instability in this regression here. And the additional 2 factors are quality factors, robust minus weak operating profits of firms, and a conservative minus aggressive investment portfolio. So what kind of tests are we going to apply? There's a lot of structural change tests out there, But philosophically, there were two that I really cared about. And it's the way that they approach structural change. A Chow test allows you to impose the breakpoint ex ante, a known breakpoint. So I've identified in that dummy graph, that dummy variable graph, those periods of narrative intensity. So those are known points that I want to assess whether or not that regression is unstable at those points. So the Chow test makes sense. But there's also the Bayes-Perron multiple unknown break test. And so that allows for a series of F tests to extract the most likely breakpoints and to see if those correspond to my narrative intensity periods. So let's just look at, for the Dow Jones 30 here, simple Chow test. And for 2000 month 10, every single 3 and 5 factor model for the individual firm returns identifies a significant breakpoint for 2010, 08, 08, and then 13, 11. For 1608, there are only 3, and the significance is weaker here for sure for Cisco, Goldman Sachs, and Intel. So compelling evidence, at least for these periods of high narrative intensity. And then the Bayes-Perron test reveals that 0807, 0806, 0808, these are popping up rather frequently, as you might imagine. But then 1701, 1702, 1703, very consistently for firm level returns. So that is somewhat supportive of the hypothesis. What about at the aggregate level? So you have a return in level terms, and then you have a return less the risk-free rate. So that's excess returns. You have 3 and 5 factor for both representations. And you see that these breakpoints based on the Chow test are quite significant, especially for the 5 factor model. So the 5 factor model is identifying these highest narrative intensity points as being significant. So perhaps those additional 2 quality factors are shedding some light on instability in the return regressions at the aggregate level. What about the unknown breakpoint test for aggregate returns? So the global L breaks versus none and the L plus 1 versus L sequential breaks find some pretty interesting results. So 0810 shows up here quite a bit. You have an 091 early on, but you have 1611 as well. And clearly there are more breaks here that are being identified than just those that correspond to my narrative intensity periods. And so that's rather interesting as well. There could be other factors that are contributing to the instability. But one thing that I concluded, from these tests as a whole is that there's a lot of evidence of instability, statistically speaking, in these return regressions. This column here in the middle tells you how many breaks there are in that regression just for 20 years. So in just a 20-year period, these tests are suggesting there's 3, 4, 5 breakpoints. So if you run a regression and try to identify one beta parameter, this evidence suggests that maybe that one beta parameter could be spurious, and you need to think about whether or not there are multiple regimes to test for that, and then maybe go within those regimes and say something. I thought that this 03-02 period was very interesting as well because this was the trough. This was the trough in the S&P 500 PE ratio and in prices and levels. This was the beginning of the upswing in stock prices that led to the global financial crisis. So that was the actual trough. So maybe reversals in asset prices are also periods of instability. What about the VIX? So what about volatility? Can we say something about instability in the VIX? There are many models for understanding VIX and Garch models. I just wanted to look at perhaps a composite representation and see if there was instability in that. So I look at a maturity risk premium, a default risk premium, an interbank risk premium, and an inflation risk premium. The Chow test is significant at 0808 and 1311, but weakly so at 1608. And the BP test is also mixed. So the results weren't as compelling for returns. But I thought, there are some other structural break tests that leave open when the break occurs and the nature of the break. And so out of curiosity, I wanted to run what's known as the Q-sum test. That's the cumulative sum. So when you run a regression, say for an estimation window of 3 years, you generate a residual from that regression. And then if you recursively add one more data point, rerun the regression, you generate another residual. If you look at the cumulative sum of the residuals, if your model is stable, statistically stable, then the cumulative sum of the residuals that are generated recursively should fluctuate around the 0 line. And the QSIM test allows you to say, well, if that cumulative sum of the residuals departs systematically, perhaps there was a breakpoint. And what's very interesting, when it crosses these bands, there's a 5% significance that there was a structural break. What's very interesting is that it crosses the 0 line for the last time at 1311 and approaches the significance bands at 16.8. These are both high-intensity narrative periods, and it crosses the band at 1701, which is a moderate narrative intensity period. So I thought that was a quite interesting finding as well. So briefly, if we introduce a macro principal component with the micro principal component, I wanted to assess whether or not macro novelty spills over onto micro novelty. And so if you take a principal component, the first component is a new series which captures the most variation from a group of series together. I wanted to look at PC1 for corporate narratives and PC1 for macro narratives. So what do? I take those metrics, the sentiment score, the novelty score, the relevance score, and the inertia score, and I take the first principal component of those series for corporate events and for macro events. And the correlation was just striking, 0.625. So it's very significant. And you can see that they do co-move over time. And so we know that Granger causality is not causality. Granger causality is whether or not the lagged values of one variable can explain future values of another variable. And so I thought it would be interesting to look at, well, if we look at just the baseline macro and micro novel events, the unscheduled event indices, the hypothesis that KU macro does not Granger cause KU micro is rejected very strongly, but not the other way around. And when you look at the PC1s of each, the same result persists, that you reject that macro PC1, that is the narrative of the macro, does not Granger cause corporate PC1. And again, the result does not hold for the other way around. So I took this to imply that there is evidence that macro novelty is spilling over onto future corporate novelty. And I think that that's a very reasonable hypothesis. So this was one of the chapters that came out of the research. This was chapter 8. So I will conclude by just making a couple comments here. There is absolute widespread pervasive evidence that unscheduled events are the rule rather than the exception, and that they are highly relevant for asset markets like the stock market. And that surrounding those events, there are narrative dynamics related to relevance, sentiment, novelty, and inertia. And the overarching hypothesis that narrative intensities do align roughly with periods of structural change, formal statistical evidence of structural change, is rather supported. And I didn't present some of these figures, but that 46,000 corporate novel events a month and over 11 million over a 20-month period, that's about 8x the frequency of macro events. So the frequency of corporate events absolutely dwarfs that of macro events. So a lot of people focus on these rare disaster events and have a lot of models trying to understand time-varying risk premia through these disaster events. But perhaps it is the corporate novelty that ensues after the big macro events that we should be paying more attention to. And ultimately, I wanted to make the argument in the book that the novelty narrative hypothesis, it's a rational part of information processing under Knightian uncertainty. And so this implies that psychology is actually a rational part of understanding a world of inherent instability. and imperfect knowledge. So perhaps models of financial market outcomes could better capture real-world behavior if they allow for KU events, narrative dynamics, and the indeterminate change that they're associated with.